Yo guys, what's up? It's the Schiller here, back again with Charkie from the Oakmont. I hope you've been enjoying the past few weeks where we've had these different sessions breaking down different things from Fibonacci sequence to reading charts and just kind of a little, trying to understand chart reading overall a little bit better. But Charkie, how are things going on today, and what are we going to be learning about?
Hey, Vaughn, I hope you're doing well. We're doing great. The Oakmont's been, we recently launched our community fund where we, quote unquote, professional traders in our group are trading a fund that is then going to be dispersing profits to our members. So we're two for two so far on our
Hey,
first
there we
trade.
go.
Yeah. So today we're going to be learning about options. It's kind of a dirty word in the stock market. But I wanted to just give a quick little update on where we're standing at right now. As you know from our two courses before and our private meetings, it's always important to look at the stock market to see where it's at, primarily SPY. So let's jump right in. So I know that there's a lot going on in my chart right now. Again, this is Thinkorswim. Don't let this chart scare you. It's just a cool looking chart with a bunch of indicators. The red and green candles are what we're looking at. So we're currently standing at around 449.72 on SPY, which is this little red candle over here. So I wanted people to take notice to this yellow dotted line coming across. That yellow dotted line was the high of September 3rd of 2021, and we rejected that price and sunk down further into October. We're at that same level again this time. Now, about a month ago, in mid early February, we also retested that level and failed. So that's pretty critical right now. So what I'm going to be looking at is for the stock market to give me any sign of what it wants to do in this little gray box here. If we're going to head back upward, then we're probably safe to start buying stocks to go up. If we start struggling to go down, then I'm going to start looking at levels to go downward. Okay. So let's talk a little bit about what most people get introduced to stocks. Obviously, in March of 2020, with the COVID crash that we had, everybody that could was trading on either Robinhood or Webull, and they got introduced to this little dirty word called options. Okay, so options. Before we get into it, I want to explain the way that it's actually supposed to be used and the way that it's actually used. So when you enter the stock market, you can buy a share of a company, whichever one that has a public listing, and then your goal is to sell it at a higher price, right? Pretty straightforward. Buy low, sell high. Options work a little bit differently. Options are a living, breathing thing, and they change over time. So if I go over here to the trade chart, you'll see here that there's a whole list of things going on here, right? It looks very intimidating and very scary. But what we're looking at is two sets of info for either puts or calls. So at the very basic level, a call means that you want the stock market to go up, and a put means that you want the stock market to go down. Very simple explanation. I'm sure somebody will go and correct me and make it more intricate, but that's basically what it is. So if I call out a trade for an option and I say it's going to be a call, I'm betting that the market's going to go up or that specific ticker. If I say put, that means that I think that the market's going to go down. Okay. Now, there are four parts of an option. There is a ticker, right, which is the name, sorry, the acronym of the company. There is the strike price, which we'll get into in a bit, the expiration date, and then the premium price. Okay, so unlike when you buy a normal stock, let's say you buy Tesla right now, Tesla's at about $1,000. All you need to know is Tesla and $1,000. But with an option, there are two other factors that you have to consider, which are time and volatility. And we'll get into that right now. So ticker, strike price, expiration date, and premium price. Now, the way that looks or the way that we lay it out is like this. So let's say I'm trading SPY. My ticker would be SPY. My strike, let's say I'm bullish and I want the ticker to go up. I'm going to say 455 call. Okay, just for our practice right now. Expiration date, let's say it's next week, 0401, and then we can take actually look at the price in a bit. So that's the basic outlook of what an option looks like. Now, the way that an option functions is when a buyer purchases that contract, they are purchasing the right to either buy or sell a ticker at an agreed upon price, which is the strike price. So this specific option here that I'm talking about, SPY 455 call 041, means that on the 1st of April, which is next Friday, at the end of the day, if SPY is above 455, I get to buy it at 455. So if it's at, let's say, 450, I'm sorry, 460, $5 above, I get a discount of $5 for buying that stock. Okay? Now, the only thing about that is that the contract is for 100 shares. So I'm agreeing to buy 100 shares of SPY at $455. Well, 455 times 100 is $45,000. Most people do not have that money. Okay? Warren Buffett does, so he does this all the time. That's how he made his billions of dollars, using these options and allowing them to expire. But most of us, most average Joes, don't have that money. So what we do instead is that we trade the premium price. So let's go into our trading module here, and I'm going to look for the expiration date. So I said I wanted to buy April 1st. So here's 1 April 22. I open that up. I scroll down here. Now, you're going to see two sides of this chart. You're going to see the left side here and the right side here. The left side is the pricing of the calls. The right side is the pricing of the puts. Okay? Now, why are we talking about options, right? Why do we need to buy or sell options? Why don't we just buy stock? Stock is going to move at a rate that's very easy to understand. For every dollar it goes up, you make a dollar. But options don't work like that. For every dollar that an option moves, your price can increase or decrease up to $100. Okay? So if SPY only moves $1 and you hold a contract that's in the money, you will actually make $100 for that one move. So that's why people purchase options, because they're a lot more volatile. There's more money to be made. So looking at this 445, so you see here in the middle of the gray bar, there's expiration date and there's strike. So I have the 455 here. So I go all over my left and I go to the last. You see that at the price is 2.25. So I'm going to go back to chart. I'm going to go back here and I'm going to change this text to read at 2.25. Okay. So what that means is that that option price costs $2.25. Now, it's not $2.25. It's $2.25 times 100. So $225. Okay. All right. So that's all the boring stuff. All right. I know half people are probably confused right now, say what is going on. Right.
Well, so for the, just out of curiosity, for like the software that you use, because we had some people asking last week of what the site and everything you're using to track. This one looks different than the one before.
Right. So the one I used before was TradingView. So that one's a free resource that you can download and get up to, I think, 3 indicators. There's a premium version as well. This one is Thinkorswim. Now, Thinkorswim is a subsidiary of TD Ameritrade. So this is the platform that I primarily use. The reason why is that it allows me to trade and chart at the same time. If you use Webull, if you use Robinhood, you cannot chart at all on those platforms. So you're gonna have to jump from one and the other. And in the option game, sometimes a minute can mean 50% to 100% on a specific ticker. So Thinkorswim, you guys definitely go and download it. They have an app. This is the mobile, the desktop version, and to me, it's the best as far as your resources to be able to trade. All right, so the pricing of these options. Now, when you hear somebody talk about an option, what I want people to think about and realize that it's a lot like car insurance. Okay, the expiration date on this ticker is giving you insurance until that date. Okay, so think about a car that you would purchase, right? And you purchase insurance, you pay a monthly premium of every month of, let's say, $100, right? And that gives you 30 days worth of coverage. Every day that goes on and expires, that premium is going to be worth less, right? Like if you, Vaughn, were to sell me car insurance for 1 day versus 30 days, I would pay a lot less for 1 day than 30 days, right? Naturally, I have less coverage. So when you buy an option, and this is where I have to warn people, when you buy an option, time is your enemy, okay? Since this is a living, breathing thing, it's dying over time. So if I were to buy a share of SPY right now at 450 and I come back next year and it's still at 450, I haven't lost any money. I'm at the same spot. But if I buy an option and at 450 and next year SPY is still at 450, I've lost a lot of money because it has to move in my direction. Okay. So now, how do we then make money doing this? So I wanted to give an example of what we're doing. So if you guys see, this is actually a real count that we started on with the Oakmont on Tuesday. We funded it only with $250. Okay. Why did we do that? Well, we want to show people that you can actually trade with a decent amount, right? $250 is probably not a lot for most people. It's something that most people probably would feel comfortable with starting to invest. Currently, we're up a little bit over maybe 35%. We're at $327. We've had 2 successful trades. If we go to monitor and look at our previous sales, you see here that we closed a trade today for Apple at 1.58, which we opened up here. So here was the last trade that we did. So right now it's at 144, but we purchased this 180 call at $128 and it closed at 158. So we made $30 profit per share. Overall profit lost at $81 as of now. So how then do we make money using options? Okay. So like I gave you the example before, if this stock moves $1, I only make $1 if I buy it. But if it moves $1 in an option, it can move up to $100. So let's figure out how that works. So if you go back to trade and you see my chart here, again, we're going to use the same example. There's 2 factors that you have. Well, actually, you know what? Let me start with the other one. Expiration date. Expiration date is your first factor you have to consider. Okay. The closer you are to the date, the cheaper it's going to be, the less valuable. The further away, the more expensive, right? So this 455 example, right? It's at 213 now for April 1st. But if I look at that same strike, let's say for Monday, which is the 28th, that 455 is going to be a lot cheaper because there's less coverage, right? 455 is at $49.49. Okay. So time, again, is not your friend. The less coverage you have, the less valuable it is. So you need the stock to move in order to benefit from it. Then you also notice that the strike price changes. Now, people get really intimidated and very scared with strike price. If I buy, let's say, a call, and I think that the stock's going to go up, and I buy a 455 call, do I need to wait until it hits that number? Or do I need to wait until it goes over? The answer is no. You can sell it at any time. You don't need the strike price to meet the actual price. All you need is movement. You need it to move closer to where your strike price is or away from it. So you see here on the chart, there's a purple shaded area, and then there's a black. So with options, we have 3 different qualities. We have in the money, out of the money, and out of the money. So we have ITM, at the money, and OTM. Okay. So in the money, this price is below your strike. It means you're making money. At the money is pretty self-explanatory. And then out of the money, its price is above your strike. So that means as of now, you're probably losing money. Okay. So this 455 call, since it's in black, it's considered an out of the money option because right now, SPY's price is only at 449.86. So if this was to close right now, I would lose everything. Okay. So another warning for people: if your option closes below the strike, you lose 100% of your money. Okay. So if I were to buy that 455 call and next Friday the price closes at, let's say, 454, I lose all of it because the contract was for 455 or above. Does that make sense? Yeah. I lose a lot of people in this part because the terminology tends to kind of freak people out. But basically, dwindle it down to two things: how fast is something going to move, and how soon is that going to happen? The faster it happens and the rate that it happens in will determine on how much money you make on those options. So how do they move then? there's two main things that we want to focus on, but there's a whole group of guys. They're called Greeks. Okay, so I'll write that up here. The Greeks. There's two of them that we need to worry about: delta and theta. Delta is the price, which means $100 per $1 actual. I'm not explaining that right now. And theta is time decay. So now we're going to get into the interesting stuff, Vaughn. All right, I put you through the boring stuff. I know you're falling asleep on me. Your crowd's probably falling asleep on us, but now we're going to see how we're going to actually make money. All right. So with the regular stock price, if it goes up $1, you make $1, right? But with options, you have the ability to make up to $100 for every contract you have for every $1 that SPY moves. Okay, delta can go and theta can go from 0 to 100. So if we go back to trade, we go back and we look at that 455 call, right? Actually, let's go back to April 1st. And again, I'm not recommending 455 call. I'm actually a little bit bearish right now, but I'm just using that as an example for today. So this 455 call, right? The price of it's still at 212-ish. Now we're going to look here in the third column. See how it says 0.32 under delta? So what that means is that if I hold this contract, right? If I buy it right now for $212 and the price of SPY moves up, right? It gains $1 from 449.88 to 450.88, I will make $32. Okay, so instead of buying this option, this ticker, and making only $1, I will make $32 for every $1. Well, that's great, right? That's a difference of, but 3,200, right? 32 times. But it's not that easy. Okay, so delta is your friend, and notice that the numbers increase. The lower you go, the more out of the money, the smaller gains you make. Down here it's 0.01, 0.02, 0.03. The more in the money, you see that the numbers increase. So you make more money by being in the money. The highest you can get to is 1.0, which is right above it, but these only go up to 0.95. Okay, so delta is your friend, but theta is your enemy. Okay, so this is probably the most important part. The longer you hold an option, the more you're going to lose. Okay, this is why a lot of the professionals do not like trading just normal options. The real money, to be honest with you, is in selling options. But for most amateurs, they don't have enough money to be able to sell an option, so they buy them instead, which is fine. You can still make money, but long term, you want to switch that. All right, so for this option right here, for 455, the theta is 0.27. Okay, so how does that work? This contract, every day that goes by, loses $27. So that means if the price doesn't move today, this is at 221 right now. On Monday, it's going to go down 28. I'm going to be like at $195. Okay? All right, guys. So delta is your friend. You want a high delta. The closer to the money, the better. And you want a very low theta to predict that movement. All right. So Right now, there's two specific tickers that I'm watching that I like to recommend people take a look at. We'll go with the safe one first, which is SPY. I do believe that SPY will start to retrace. I think we're going to head down at least back to this dotted blue line, which is the 200 EMA, somewhere around here, 441, 442. So I'll activate this. I'll make this blue as well. So somewhere around there. So if I were bearish, I would buy a put, which is the opposite of a call. So I would go to trade, same date expiration, and I would be looking for something on this side.
Well, I feel like I might be wrong with this, but like putting a put sounds like easier than making a call. Like I feel like you can for certain options for certain stocks and everything, right? Like when you know that there's like a big piece of news that's coming out that's like potentially negative, or as soon as that happens, is it like a rush and that's when people like run to
Yeah,
do stuff, or is it more kind of people just like reading the charts with your Elliott wave theory and everything else?
right. So the way that I describe it to people is that using Elliott wave is kind of like telling a story, right? We're predicting where things might go. So right now, I'm predicting that SPY might go to 442. I then use my indicators to confirm that that movement is correct. And if we look at my indicators, the RSIs are overextended, the MACDs are starting to curl. So there's a little bit of a hint that we're starting to roll over and roll down. If that happens, it happens suddenly, then I can really make a lot of money. Wow. Now, this is what happened during COVID, right? In March, the markets were dropping close to 3 to 4% per day, as high as 8% total in the market. We've only seen one day like that this year. I think it was back in September. We dropped around 3% in one day. We have not seen that at all since 2020. Back then, people were making, and I'm not kidding you, 10,000% gains on a daily basis. A very young guy who I don't know where he's at now. I think he was like 16, trading with his mom's account. He invested I think like $3,000 one day. Woke up on the following day, and his account was up to $62,000 in that one day
Sheesh.
trading options. Now, he got extremely lucky. Luckily, he pulled out a big chunk of that. His parents were obviously very happy, and he moved on. Now, you were talking about having specific information. Now, the place where options can be the most beneficial are during earnings seasons. Okay, so as you know, publicly traded companies have to announce, the profits that they're gaining or losing every quarter, and they do that through an earnings report. Earnings report can make stocks move as high or low as 10, 12% sometimes. So if you pick an option in the right direction, you can profit, easily in the thousands percents wise. But again, it's a very dangerous game. If you don't get the movement that you need, you're going to lose money. So that's why it's very important to do your due diligence, do your analysis, really study these companies and know what's going on. So I'm going to throw out there another dirty word. It's called the Lotto. Okay. This happened a lot back in March. People have made a lot of money, but people also lost a lot of money in 2020. Okay. A Lotto is basically a ticket to a trade that will either make you a lot of money or lose you everything. And that's for my good old friend AMC. Okay. AMC right now is setting up a beautiful breakout to the upside. Okay. Um, if I move to a weekly chart, you can kind of see it better, right? You see that these indicators are pointing upward. These are all curling upward. And you see a really good base down here, right? We had this spike back in March of the same time last year, and we've been trading down ever since. Now, we did our homework last time with Fibonacci, right, Vaughn? So let's look at our retracements. So here we have a low down here of like, what was it, $1, $4, $2, right? In looks like 2021, right? And then we had a high up here, 72. Okay, so you see that it broke down, and where did it bounce at? 61.8%, right? We talked about that. It went up, but then it rejected, and it's been coming down ever since. Well, look where it's lying at now, 78.6, which is very definitive of a wave two. Okay, So as long as it holds this level around $15, $16, AMC should be fine. Okay. Now, how do I confirm if the downside move is over? Well, we used our friend retracement. Now let's use our other little buddy, extension. So I'm going to measure the top of the move down to the bottom of this first wave and then upward and let that lie. And here we are again down to 78.6. Now we have not fully extended all the way down to the 100% level. That is still possible. We can hit 10%, or $10. All right. But for the time being, if we go back to the 1-day chart, we'll see that there's actually room. Now, this dotted line, this is a very simple trading strategy. It's a 200 EMA. Basically, it weighs the average price of the stock over 200 periods. It's probably the strongest one. You see that how strong it was. It does kind of give that vibe like it's going to come back up. So if we measure where that price is at, it's right around $25 right there. So go back to my daily chart. And there you see that we're starting to get more volume. We're starting to get more breakout to the upside. So here's my bold prediction. I do believe that there's a good chance, if everything goes well with the market, we could see $25 this next week, which is almost a 25% move on the stock. Now, 25% in the stock price could be, and probably will be, roughly around 800 to 1,000% in options. Okay, so your $10 could turn into 100, your 100 could turn into 1,000, and so forth. So I set up a trade on my own called the debit call spread, which we'll talk about a couple of weeks down the line because that strategy is very intricate. But basically, I only risked $10 to make 100, 900% gain, and I bought 10 of those contracts. So I'm risking 100 to make 1,000. If next week at any point AMC breaks $25, I will profit on that trade. All right, guys, I feel like we've done a lot today. We went into some pretty crazy stuff.
I'm gonna need to rewatch this entire thing. There's so many different aspects really to kind of break down with it though. Like I mean, just from like the different kind of terminology to figuring out okay what you feel comfortable with doing and then getting into it. Because again, for me, like I've not really kind of jumped too heavy into kind of like the stock market aspect. I've always kind of just been for crypto within different like projects that I kind of like know and understand fully. And for this side of things with the different earning seasons, with the terminology, and I mean, listen, the Fibonacci and the Elliott wave theory that was mind blowing enough, and I think for like I mean, if there's one thing to take away from this Charky regarding kind of like this lesson right here, what do you think's maybe one or two of the big things that you should really kind of just remember?
I think for anybody who is interested in getting into options, because I think that they see it on social media, they see it on Twitter, they see these guys claiming these 8,000% trades and so forth. The most important thing to remember is you've got to have a plan. You have to know, or at least have a strong conviction, confidence that something's going to happen. And if it doesn't happen, it's okay. You move on to the next trade. But you have to have that confidence that it's going to happen. And the only way you could do that is by having a very specific trading strategy, which for us as Elliott wave ticians, right? We know that certain numbers go to certain places. We know that through our experience, certain prices, right? We went through support and resistance last time. And look at, I literally just drew this line out, you guys, this little yellow dotted line. I drew it out to show you that this area right here is important, right? We stopped here, we rejected. We stopped here a little bit, we broke up, we came back, we retested that same level. We broke up, we came back, we retested that same level. We broke up, we broke down, we came up. What do? We retested that same level. We broke down, we're coming back up. So what do you think we're going to do now? Are we going to reject again, or are we going to break through, right? I don't think we stay in the middle. I think that we're going to either come down sharply and we're going to come up sharply. Now, as far as choosing either puts or calls, there's a famous little analogy that people like to use. It's called stairs up and elevator down, okay, or escalator down, whichever one you want. We always climb up slower and we always fall harder. So options, when it comes to pricing, puts tend to pay a lot more because they fall a lot faster than the gradual melt up that stocks have. All right, you guys. Well, I really hope you enjoyed this, and hopefully it's beneficial to you. Options are definitely fun, but they are a gamble. I will be honest with you guys. And here's the very interesting thing, Von. there are certain platforms that allow options trading for crypto.
And there we go.
I'm scared, to be honest with you. I'm scared to do options for crypto. Even though I feel like I'll be very good at it. I actually called out ADA to move about 20% from around 90 cents to $1.18, and it hit that a couple days ago. Um, the whole maybe next week we can go through and recap what we went through last time, the first episode with Ethereum and Bitcoin,
Yeah, for
because
sure.
they're hitting our targets right on what we said. So yeah, I would say advice for now with the stock market is just proceed with caution. Okay, guys. Right now we're overextended. All of the charts, all the indicators are showing too much of a move down. We need to consolidate. Remember that the arrow can only go forward if it's pulled back.
Love it. Love it. All right, guys, listen, if you've enjoyed this lesson and you're thinking, hey, you know what? I kind of, having a one-on-one with Sharky sounds kind of fun, and the entire crew at Oakmont, be sure to check them out on Twitter at the Oakmont. It's a private Discord group where they go over stocks, crypto, options, the whole shebang. And again, you get to see it here first. And don't forget to tune in next week for another session with Sharky from the Oakmont. Sharky, thanks so much for coming on, and I guess I'll see you next week.
Thank you guys so much.